To have a surplus of funds in this marketplace is definitely a luxury. So if you fall into this particular bucket at this point in time, congratulations are definitely in order. But what do you do with those funds? Where do you invest those funds, particularly when you're in the throes of a recession? And that is what I'm going to talk about in this video. But a real quick note first, I'm not going to spend a lot of time talking about emergency funds. I'm not going to talk about paying off your high interest credit card debt. I'm not going to talk about 401k type of investments and the matching and taking advantage of that, making HSA type of contributions. I'm not going to talk about any of that kind of stuff. That kind of stuff is table stakes in my opinion. And of course, if you want to get further visibility into how to go about doing those sorts of things, definitely check out a lot of the content that Dave Ramsey puts out. I'm assuming that table stakes effectively are already taken care of, and now you have a surplus of funds. So you are in a position of power, if you will, and what to do with those funds if you are lucky enough to be in this particular situation. But of course, before I get too far into it, don't forget to smash the like button for the YouTube algorithm, subscribe to the channel, ring that notification bell, and of course, let's get into it. When the stock market is in a recession and there are substantial price to earnings type of multiple declines, an opportunity to increase your investments or your exposure into quality assets at favorable valuations. And even broad market ETFs is certainly a good opportunity to invest in if you certainly don't want to go down and do the approach of finding and picking individual stocks. What's important though is absolutely key when making these types of investments at this time is to press those investments. And when I'm talking about pressing those investments, what I'm referring to is effectively putting in more than you traditionally would if you were going through a month-over-month type of an investment cycle, because you want to take advantage of the market, which is effectively on sale. The S&P 500 is corrected over 20% and the NASDAQ is corrected over 30%. So it's put a lot of stocks and a lot of equities in a very desirable position from a price to earnings multiple perspective. With my own personal funds as an example, every time there is a 10% decline in the market, I'm barreling in 2 to 3 times the investment that I would traditionally make on a month-over-month basis to take advantage of the prices that we're experiencing in the market. Now, if you certainly have the proclivity to take on incremental risk, there's certain sectors or certain segments in the market that are effectively hurt even more at this stage, i.e. the NASDAQ 30% reduction that I talked about earlier in this video. So if you have a proclivity for risk, tech stocks are certainly up for sale at this point. But of course, there are a varying degree of tech stocks out there. Some of them have earnings, some of them don't have earnings, some of them are these bellwether type of stocks. So it is important to pick the ones that you think will be successful, of course, based on the value that they provide to society. And if you don't want to do that, or if you don't know how to do that, certainly picking some of the bellwether stocks such as your Apples, your Amazons, your Googles, your Nvidias, those types of brand name stocks, they're effectively not going to go anywhere. These are, of course, tech royalty, if you will. And outside of tech, if you still want to maintain some level of investments in the stock market or increase your investments in the stock market, definitely look into certain things such as the consumer staples sector, not consumer discretionary consumer staples, because of course they are not impacted when it comes to various changes in the economic conditions. Outside of stocks and investments, there are other things that you could perhaps look at is certainly things like investing in real estate. Now, I'm not saying go out there and invest in real estate at this point in time, like at this very minute or this very month. What I'm referring to is just watch the market, because certainly as interest rates continue to go up, eventually it's going to have this adverse impact when it comes to the overarching state of the consumer, and they are going to start pulling out of the real estate market. And you throw in things with loss of jobs and things like that, incremental risk in the market is definitely going to create a problem as well. It's always difficult to pick the bottom in the stock market, but there are certainly several indicators out there that would suggest that there's perhaps some light here at the end of the tunnel. Unemployment is certainly starting to increase. There's definitely more pressure on the housing as well as the used car market. Manufacturing index is deteriorating. Consumer confidence numbers, as reflected in the University of Michigan Consumer Sentiment Index, is definitely at multi-decade lows as well. Bonds are suggesting a contraction, and of course the Atlanta Fed GDP Now report is suggesting that we are in a recession already. The light at the end of the tunnel comes from the notion that as the Fed continues to increase rates, there's going to be a reduction in demand. And as there is a reduction in demand, eventually it's going to result in more of a contraction of the overarching economy, due to which the Fed is going to have to take their foot off the gas. Now, the key thing to note here is the market is, of course, forward-looking. The market is thinking about it in the same way. Therefore, a lot of the deterioration in the stock market is certainly getting factored in. The market is now trading around 15 to 17 times price to earnings multiples when it comes to overarching stocks. So even if you purchase stocks at this point in time, you're at least not getting hosed, because you're getting stocks at a pretty decent multiple. It's a lot better than the multiples that were previously trading in the market, where they were trading at 25 to 30 times price to earnings multiple. One of the things that you definitely do not want to do while you're in a position of power, when you have a surplus amount of funds, is leave a lot of your money in, or a lot of your capital in cash. You need to have enough capital to basically barrel money in as these opportunities, of course, present themselves. Because in an inflationary environment that we are in right now, all that capital is effectively losing value on a day-to-day basis. Some of the largest bull runs take place immediately after a recession. At this point in time, we're 5-6 months in already into the recession. Recessions have, of course, lasted a lot briefer periods of time, and some have lasted a little bit longer as well. The average recessionary period, for all intents and purposes, is right around 12 to 13 months. But if there are certain macro changes that take place, for example, with Russia and Ukraine or something like that, all of a sudden it would result in a significant boost when it comes to the market, and you do not want to miss out on opportunities such as that by sitting on the sidelines. Good quality over quantity is definitely the name of the game in recessionary periods, and when it comes to those quality type of investments, it's effectively useful to barrel incremental amounts of cash into those investments. Other investments are there that you think are very useful during recessionary periods? Include all of that in the comments below, and of course, if you have made it this far, don't forget to like and subscribe, and I'll see you in the next one.